Hey everyone, welcome back to part 2 of me revealing my entire stock portfolio. If by chance you haven't watched part 1 yet, I highly recommend you go through that one and skim through it first. It'll just make a lot more sense. I'll link to that one in the description of this video. And before getting into it, if you guys like this type of content, please subscribe to the channel. Click that little subscribe button in the bottom right hand corner. We're currently sitting at 16 subscribers. Would love to get it up to 20 plus subscribers with this video series that we're doing. So would really love the support. Also, if you own any of these stocks or just want to say hello, would love to interact with you guys in the comments and meet some more of you guys. So let's get into this. Going to go through this very quickly because we went through it in the last video as well. But super briefly, my stock portfolio consists of 28 stocks. I do also own ETFs, but I'm not including those in this portfolio. Those are kind of held separately. But there are about 10 to 15% of my overall portfolio. I am a Canadian citizen, so I do own both US and Canadian equities throughout my portfolio. And my portfolio, you'll come to realize pretty quickly, is highly focused on dividend paying companies. I do own some non-dividend paying stocks, but they are far and few between throughout the portfolio. And then obviously, as we get closer to the top of my portfolio here, we will start to uncover companies that I have higher and higher conviction levels at. Lots of the ones kind of in the bottom, I'm either averaging into, waiting to see a thesis play out or something like that. But you'll start seeing the weightings at the top get significantly higher as we get to the top 10 positions in this portfolio. So moving on from what we shared in video 1, I'm not going to go into them too much because you should watch that video if you're interested in any of these names. But going from the bottom up, Airbnb, Diversified Royalty Corp, AT&T, Canadian Utilities, AW.UN Royalty were the companies we talked about in that video. All of them paying a dividend except for Airbnb, and all of these actually paying a 5+% dividend. So at the bottom of the portfolio, getting a lot of yield, a lot of cash coming in to invest in other things across the portfolio or whatever I think is of good value. Airbnb is a bit of a interesting one that I'm not exactly sure what I'm going to do with that position yet. Want to wait and see how the company does, how the stock does, and we'll go from there. Going into number 23 on my portfolio, Fortis. So Fortis is a utility energy company that operates across the US, Canada, and the Caribbean. And they are a big company in Canada, like registered in Canada, but operates across the US and Canada mainly. That has a great track record for creating value, heavily in a regulated utility space. So very safe company, almost like a bond-like security. If we look at their stock over the last 1 year, they've held up pretty well given the grand scheme of things, and that's just the nature of this company. Their operations haven't been materially impacted by interest rates or fears of recession or anything like that, just given the nature of the business. So that's the good thing about these companies. They're not as volatile. But with that being said, in a very good year, this kind of company is likely to underperform. So you take the good with the bad. But I like the stableness of it. It's paying a 4% yield. It's increased the dividend, I think 6+% since I've held the stock over the last 5 or so years. So great dividend compounding growth. Pays out its dividend every quarter for the last, I think, 49 years. So this is a company that's very stable income, very bond-like, except you get a little raise every year. And it's very heavily dependent on regulated utilities. So it's not much that can happen that's going to completely shake up their business. Looking into where they operate, so like I said, a Canadian company, so they're big in BC, they have a big presence in Ontario, Alberta, they have a big business too, and then I think they have a small business out on the east side of Canada, but they're really a North American business. So I think like 15% of their overall revenue comes from Hudson's Yard in New York. They have a big business in Arizona that's like 20 to 30% of their revenue coming out of there, and they also play in the Caribbean here, so Caymans, Turks, Belize. Not a big part of their business. I think 4 or 5%, but still worth noting that they have some exposure there. Going into the 22nd highest position is Restaurant Brands International. So Restaurant Brands International, ticker QSR, is listed in both Canada and the US. They own Tim Hortons, which is obviously a mainly Canadian franchise, Burger King, which is very global, and Popeyes. They also acquired Firehouse Subs about a year ago, represents about 2 to 3% of the company's revenue and income. So still fairly small, but their whole thing is about driving a lot of scale and franchising globally. So taking these brands from North America and opening a lot of new locations, taking in all of those royalty fees and income, and building the brand and the business from there. Looking at the stock's actually performed very well over the last 1 year, up almost 25%, despite the market being down 10-20%. I think the last little jump in the stock here was because the former Domino's Pizza chairman has just become the chairman of this company, and there's a lot of excitement over how he was able to globally scale that operation and create a lot of compounded value for their shareholders. But even before that jump, the stock performed really well based off of same-store sales growth starting to turn around. Burger King, Canada coming out of more severe COVID lockdowns and protocols, and going back to office really accelerated Tim Hortons' growth closer to pre-COVID levels. So lots going on this business. I'd say I think about half of their income's from Tim Hortons, even though I think it's the least amount of stores they have out of all the three. And that's just because I believe they own lots of their locations on Tim's, whereas Burger King and Popeyes are primarily franchised. So it's an interesting dynamic there where one of the smaller brands in their business in terms of global footprint represent the vast majority of the company's profits. But I'd say that strategy is really not where the company is going. The company's really looking to drive scale and franchising globally in order to have like an asset-light business model going into the future. This is just a quick summary that we talked. So not the smallest, but you can see BK has almost 20,000 locations. Tim's has 5,000. Popeyes has 3,600. So out of the 30,000 locations, 5,000 locations is 50% of the company's profits because of the ownership of the physical locations in lots of them. They also do a lot of franchising within this 5, but significantly higher company-owned stores here than either of their other brands. So you can kind of see like how they're scorecarding themselves. They really want to be in more and more markets, be more and more global. And as you look at it, Burger King is truly a global brand, over 120 markets. That's phenomenal. And Popeyes, they're looking to get there. I think they've already expanded into a lot of new markets since acquiring that brand 5 years ago. And then Tim Hortons, I know that they're trying. They've had some successes, some failures. So we'll see how that plays out. But they are also trying to grow the global exposure of that business and where that brand plays. So just going through these slides off the cuff a bit here, they're looking to have 40,000 restaurants, and that's kind of like what they're glide pathing towards. That's a lot of restaurants and a lot of businesses. So you can kind of see how they've been able to trend towards that. This is a bit misleading because there's lots of acquisitions in here with Popeyes and stuff like that. But that's their goal. They had a bit of a slowdown in 2020. I think this slide's about a year old, so they didn't fully report 2021 yet. But they're really looking at using the health of the business, obviously, to drive store count growth. So stronger brand awareness, driving higher sales per store, which is driving operating leverage, which improves profitability, which obviously has a better model and sales approach to franchisees potentially looking to open up new locations. So that's kind of their flywheel that they're working towards to try to accelerate store growth globally. And then very similar, just their value proposition. They really focus on having iconic brands. And I know they've been in discussions with a lot or gotten pitched to buy a lot of different companies. I know there was a couple brands in China that were trying to sell themselves to RBI, and they ultimately didn't go with it. I think they really want iconic brands that they feel can do well globally and in all kinds of markets, and that's where they focus their acquisition strategy on. So building out a portfolio of iconic brands that can deliver sustainable growth, which then can leverage their integrated technology platforms across their total RBI business and just drives a lot of scale and operating leverage for them to continue to improve store growth and continue to create value for shareholders. So RBI is an interesting one. I'm thinking of doing a much larger video going through their entire business and each of their brands. Let me know in the comments if that's something that you'd like to see, or if you own this stock, what your thoughts are on this business as well. It's a pretty small position for me, just because it's not the cheapest company by any means. And I also own a couple other restaurant businesses, so I don't want to be over invested in the space. But I love the business. It's one that I'm definitely going to continue to hold on to. And I love the fact that it pays a pretty good dividend as well. Going into number 21. So number 21 is Amazon. So I do own Amazon stock. It's one of the only companies I own that isn't very reliable with its cash flows, doesn't pay a dividend, but it's just a business that I want to have some level of exposure to in my portfolio. Looking at the stock, it's obviously gotten crushed over the last year. My history with the company is I was buying this stock before COVID. So I'm trying to think, probably pre-stock split was $1,000 to $1,200 range. So divided by 20, so like probably like $60 a share, give or take. And then it went all the way up to what now would be $150, $160 a share. I didn't really add to it. I thought it was, pretty expensive for their cash flows and stuff, but I still didn't sell because I like the exposure to the overall company. I think they could do great things in the future. And now they've kind of come back to earth a bit, trading at about $1 trillion valuation, $98 a share. Just given, what I'm focused on primarily, dividend investing and being able to have like tangible value in terms of the current and immediate future cash flows of the company. This isn't one that I'm looking at adding to. So it'll probably stay at a very small part of my portfolio. And as the portfolio grows, it'll get smaller and smaller. But I do like having some exposure to Amazon, given the types of businesses they're in. And just to talk about their business a bit here, what I'm really excited about for their business is the left-hand side of this chart here. So obviously they have the largest online store in the world. That's great. I think there's opportunities in, cutting costs and driving scale on the top line to hopefully make this a bit more profitable. I think it's barely cranking out any net income for the company. Physical stores, not why I bought the company. I guess it's a good complementary asset to have a physical presence for their online business for pickups and returns and stuff like that. But I don't really care about that side of the business from like a revenue mix or a profit center point of view. But I'm really invested in the company for their opportunity to leverage advertising on top of their retail business. AWS is probably the biggest thing that I love having exposure to with this stock, and then their subscription service. So having that recurring subscription service on essentially everyone in America, I think is very valuable. So I just hope the company, at some point as it reaches scale and plateaus on growth, starts focusing a bit more on returning capital to shareholders, but either buying back shares or stop diluting shareholders with the amount of new shares they pump out there, and just start getting to a spot where they're consistently pumping out free cash flow, net income, and finding out ways to return it to shareholders. They're not there yet, but I think with the growth areas they're in, I'm hoping eventually they have more money than they know what to do with, and they start putting in a capital allocation strategy that's more favorable for shareholders. Until then, it'll remain a very small part of my portfolio. Stock number 20. So this is the first of many real estate investments you're going to see. This one is Northwest Healthcare Properties. Northwest Healthcare is a REIT that is listed in Canada, but it's really global. So they have operations in Australia and Europe. They have some hospitals in Brazil. They own a couple hospitals in Sydney and Melbourne, I believe. So this is a very global business. They pay out about a 7.5% dividend. The vast majority of their earnings are coming from these very long-term leases on hospitals with governments, but they also own other types of asset classes. Just to flip through the slides here a bit, they look at anything that has to do with health as an area they're interested in. So they do own lots of buildings that are catered for like doctors' offices and even I think some like dentists and stuff like that. So anything health related is in their scope of potentially being a landlord for. They are starting to invest more in life science type real estate, which charges very high rents, but is very expensive to kind of build out. And this is just kind of where their core business is now. They've talked about interest to varying degrees on this side of the equation, but I don't think they've done anything meaningful as of yet. In terms of their overall strategy, so they have very long lease terms of over 14 years on average. They're looking at accelerating the portfolio in terms of where they play. So they just made a big acquisition in the US. One of the watchouts with this company that's kind of changed since I started investing in it is at first it was a very, very consistent, very safe, like a very typical REIT. Over the last number of years, they've pivoted in many ways. So they started doing a lot of joint ventures in miscellaneous markets on miscellaneous hospitals and different types of assets. They've acquired huge businesses in Europe, I believe Germany. They just made a huge acquisition in the US. So they've become a lot more aggressive. They've also, as you'll see on the third point here, formulated this asset management business that they're really looking at managing hospitals and driving fees from that. So a lot of complexity has gone into this business. To be honest, it's very hard to read their results now because it's so many moving parts. There's always acquisitions, dispositions, swings in management fees because of performance. It's not a typical REIT, and it's very hard to kind of value now because of how many moving parts there are. So that's the one thing I haven't loved about owning this stock and has kind of held me back of considering to make it a bigger part of the portfolio, because the total image of the company is a lot more clouded than I feel like it once was. With that being said, I do like the yield. I think it's around 7.5%. So this is one that they own high quality assets. I wish they'd stop taking on debt to do acquisitions and focusing on ancillary business models and stuff like that. But I'm holding the position I currently have and just taking that 7% dividend that gets paid monthly and flowing it into other opportunities in the market. All right, stock number 19 is Savaria. So many of you probably haven't heard of this company, especially if you're not in Canada, because it's a relatively small business, under $1 billion market cap. But this is a company that focuses on mobility. So think of like stair lifts, the things that let people get in the cars with wheelchairs, accessible vehicles, stuff like that. That's where this company really strives. Also, commercial elevators for like one floor elevators for people who can't take the stairs, and also residential elevators. That's a big part of their business. So I got into this company years ago after it really ramped up, probably around $9-10 a share. Since then, it's consistently gone between $10 and $20. Went up to 20. Obviously, this is COVID, and then up to 22, 23, back down to 15. So it's been a bit of a journey with this company, but generally speaking, they consistently pay out a dividend, currently at about 3.5%. They've increased it every single year since I've been a shareholder of this company. So they have a strong track record of increasing the dividend. Just going into this company a bit more and giving you guys a better sense of the kind of business they're in. They are in home elevators, commercial lifts, stair lifts, ceiling lifts, adapted vehicles. They also sell like ancillary products like canes, medical beds, therapeutic surfaces through a company they acquired a number of years ago. So they're really a demographics play about more people, baby boomers and such, getting older and needing these kinds of services. Also, they're a play for people wanting to stay at home longer in life, as they have these stair lifts and stuff like that for people that enables them to maybe stay in their home longer before going to an old age home or a retirement home. They operate globally. So they have a US business, they have a Canadian business, they have a big European business. I think they also have some sales, or at least a vendor in China that sells on their behalf. So this is a business that's Canadian, but you get some global exposure. One of the big issues that they've had is they primarily produce their product in China. And with COVID over the last number of years and the policies of that government, it's been tons of shutdowns of their warehouses and stuff like that, which has really hurt the supply chain, really hampered results. And that's why you see the volatility of $20 to $15. I really think that long term, they're going to get over their logistics issues. So they've actually just opened up a new manufacturing plant in Mexico that they're going to start splitting their production between China and Mexico. So that should help them diversify their supply chain a bit and not be completely reliant on China and COVID in China and Chinese government policies. So looking forward to that, just will be interesting to see what that does to margins, as I know their Chinese business was pretty cost effective in terms of the production side. Going into their earnings here, so did 30 million in EBITDA last quarter. On the year, they do about 15%. So after their recent acquisition, which they kind of diluted shareholders behind, I think it was another stair lift company in Europe, they should do over 100 million in EBITDA this year, and they're trading for just under $1 billion. So not a crazy valuation, 10x, let's call it 9 to 10x EBITDA for 2022. But this is really an investment that I make based off of the demographic trend of people getting older. I don't have a lot of healthcare in my portfolio, so this is kind of the one space from a retail side that I think I'm getting some exposure to that. And while I wait, I'm getting an increasing dividend that's paying me 3 to 4% starting yield. So that's my position here. It's not one I'm actively adding to, but it's really dependent on where the price goes. So if it gets to a valuation that I think is attractive and the business results continue to be strong, then it's one that I'd consider adding to. Number 18, and the last one we'll go through in this video, just to keep these relatively short, is Allied Properties. So Allied Properties is a Canadian real estate company. It's a REIT that primarily plays in flagship office space. So they're in only big cities and office hubs. They don't really have secondary, tertiary type of office space. These are truly trophy assets. Their biggest business is in Toronto. And historically, Toronto's been one of the best office markets in the world. Just the economy was growing very quickly. Many more businesses moving to Toronto. You couldn't find office space. Occupancies were like 98% forever before COVID for a number of years. But since COVID and lots of people working from home, lots of offices going remote, office occupancy, I believe right now is like 87%. And that soundbite of office occupancy dropping to that extent and showing no sign of recovery despite people kind of going back to normal life has hammered this stock. This stock, historically, I think their net asset value is like $55 a share, but there's just a lot of concern on just the asset class that they primarily play in, to be frank. So this company's gotten hammered. This historically used to be a company that traded over 20 times earnings. So I love their assets. I love where they played. I walk by their assets a lot and stuff like that, and they're just unreplaceable real estate in the core of downtown cities. But it was always such a small part of my portfolio since I just had so many better opportunities in real estate and REITs than buying something for over 20x FFO. So this is one that I've actually added to a bit over the last 3 to 6 months as it's kind of traded in this 30 to 25 range. It's breaking out a bit now. But this used to be like my smallest position in my portfolio. Now it's not the smallest, but it's still pretty small. I'd be willing to invest a bit more in this one. I'm not going to make it a huge position, but right now we're trading at like 12 or 13 times for flagship assets in downtown cities. And they own more than office real estate. They also own great retail real estate, some apartment real estate, but that's more exploratory at this point. And they also own some parking lots as they wait to develop for the future. Looking at their mix and what I was just saying, you can see like this is an office REIT. You can see, 3/4 of their revenues coming from office. But they do have some real estate in the bottom of their buildings. They do have some parking lots that they're waiting to potentially develop in the future, but they're monetizing for now. So it's nice to have some of these elements to the business that's providing stability as they may face some headwinds on the office side, but it's an office REIT at the end of the day, a big flagship office REIT in Canada. I would mention that despite occupancy rates going down nationally, they've held up pretty well for Allied. And their hypothesis or their selling point is lots of the best office space is not getting diluted down in terms of occupancy rates. It's really that secondary, tertiary, older type buildings. And their results kind of prove that so far. So their funds from operation and their revenue really hasn't ticked down at all. They're actually growing slightly. So I'm kind of buying into that logic that the best office space in the country will still have very high occupancy rates. And even as maybe the office pool in general demand goes down, these guys will be fine. Maybe they won't be able to accelerate rents and lease terms as aggressively as in a tighter market. But trading at 12 or 13 times for these types of assets and the growth that they have in their development pipeline, I think it's a good buy as long as it's not too big of a bet in someone's portfolio. That's just my opinion. Just to give you a sense for the size of these assets and these businesses, these are their top 10 office locations by NOI, I think, but you can kind of just get a sense of the fair value of these businesses or these properties. $328 million, $423 million, $353 million. These are all between $175 and $300 million for these buildings. So these are very, very big, very expensive prime real estate assets that you're buying here. You're not buying these little office buildings off the corner of the highway or anything like that. And I think I can also do a future video on Ally, just going through more of their assets and the investment case here. But I like the stock. I think it'll do good long term, and that's why I'm in it. I think one more here is just to give you a sense of Toronto and the properties that Allied owns in Toronto. You can kind of see, if you're familiar with the city, this is just the downtown core, and they just pretty much own this area here in King West. They have some presence in St. Lawrence Market, Entertainment District. They're buying up a bit as well, but they're just a huge landlord in the city. And Toronto as a city continues to grow. Rents continue to go up. So I think the stock price is overdone in terms of the downfall based off the narrative of office space going away. And then lastly, they have been increasing their dividend year over year since 2004. I see they halted it a couple years after the Great Recession, but they didn't cut it at all. So that's great to see that they continue to increase their dividend. They actually just announced another dividend increase this month for 2023, I think just up to like 180 a share from 175. But great to see in a year that their stock price halved. The narrative around office space got turned very negative. Their revenue still held up, and they didn't buy into any of the concern. They kind of held to their guns, and they increased the dividend again based off of their business performance. So as a shareholder, I like to see that. And hopefully they talk about building out their development pipeline. They have lots of things that are going to go live in the next 12 to 18 months. And then as those go live, they said they'll consider doing share buybacks, but they're still prioritizing returning dividend shareholder capital or capital to shareholders rather through dividends for now. And then they'll see where the unit price is after their kind of 2023 pipeline goes live. Anyways, that is stocks number 24 to 18 in my portfolio, the completion of part 2 of this series. If you like any of the stocks in this video, let me know down below if you own any or your thoughts, if you like them, if you hate them. Would love to hear your perspective on the stocks that I hold in my portfolio. And if you like any of this analysis going through the stocks in my portfolio, please let me know in the comments. Please subscribe to the channel. Let's try to get up to 20 subs. And thank you guys all for your time and watching this video. I'll see you guys in the next one.